This is Michael Douville in Scottsdale, Arizona. It is June 14th, 2016. Lots of things in the news, a couple things I certainly want to be sure that I bring to your attention. The market again is starting to move down. It's at some resistance levels, gone up. It's almost to record levels. As we've discussed in the past, earnings are down, the economy is slowing down. There's all kinds of red flags. There's things around the world that look like trouble, and it's maybe time to start thinking that maybe we need to take some money off the table. We've been talking about this for 6 months to a year and a half, that the economy is slowing. The real estate market here in Phoenix has been doing absolutely outstanding. Rentals are incredible. Our business model that we've been talking about for the last 10 years is doing exceptionally well. Right as per forecast, we do have rents in 2014 went up almost 6%, 5.9%. Last year in 2015, we're looking at almost 9%, was 8.94%. We haven't quantified for 2016, but we are looking at some pretty hefty rental increases. Don't think they're sustainable. So we're really happy with them. We're actually going to give our tenants a little bit of a break. We're not going to take them all to market because we want to keep these tenants. I do think that we're going to be starting to go through a little bit of a correction on valuations. Just as the economy is going to correct a little bit, I think we're going to have a little correction, but that is strictly a correction within an ongoing bull market. I look at the cycles here for Phoenix, the rest of the country, and of course for here Phoenix in particular. Phoenix just looks phenomenal. So we might correct a little bit depending on how tough the economy gets. Could be a buying opportunity, but here again, the dilemma, of course, is if we're going to have a correction, do we wait to buy something during the correction, or do we buy now? So here's the dilemma: is that we have rates at a historical low. I mean, historical low. I mean, Martin Armstrong's saying they haven't been this low for 5,000 years, so that's pretty doggone low. Economy gets a little tougher in the near term. In the near term, I'm talking about 60 to 90 days. I think that rates could even get a little bit better, but I don't see them staying this way. So if we run into problems, I think that here again we've talked ad infinitum that debt is a problem here in the United States, here and globally. So I see as risk enters the market, you're going to see interest rates rise, and it could rise reasonably substantially. So do we wait till next year to 2 years to buy it? Maybe a little bit, and maybe a little better pricings. But I think that you run a real risk of much higher interest rates. And of course, if the economy gets tough, then we have a difference in underwriting. The banks never want to lend when things are bad. So I think you do your acquisition here. You maybe don't deploy all your capital, but you still want to deploy some of your capital and get that cash flow. We want to get capture these long-term rates. And if things do go bad, why this gives us an opportunity to sit back and collect dividends from our cash flowing properties, and that'll help mitigate whatever problems we have in our day-to-day business. So. I think we probably we do want to deploy some of our capital and capture some of the rates that are going. We do have some excellent properties. I mean, here in Phoenix, we can still buy properties that are going to cash flow, and these are real cash flowing. This is not just PITI, because of course as an investor we always have costs more than just the payment. We have costs of sales, we have management costs, we have vacancy factors, we have repair factors. I mean, garbage disposals break, dishwashers break, we need to put new flooring in, we have to paint. These factors need to be factored into our costs, and after factoring all those costs, we still get a reasonable cash flow. They are anywhere from 4% to 6%. Once in a while we get a little lucky, we can get a little better. 5 or 6 or 7 years ago we said, oh, that's too low. But of course, when you're in a zero interest rate environment, I mean, you have to understand that 40% of the bonds being paid today are negative. So if you can get a positive cash flow, 4.5%, you're way ahead of the game. Plus, we have appreciation if we put some mortgages on these properties, put a little bit of very conservative leverage. Why, of course, we get principal reduction, which adds to the total return. So our total return is still going to be very, 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 very strong. So it's still very, very compelling. Phoenix metropolitan statistical area is still one of the top windows in the nation so far as growth. We're sitting right next door to California, and of course California is just bleeding jobs. It's just bleeding population. So we're going to be the obvious recipient of that, and jobs are very, very good here. So we're still very, very strong on Phoenix. There's some other places around the country, but right here in Phoenix, we have a full system in place for non-owner occupants and absentee landlords. So we have management companies, and we have rentals. We have renters in place. So just an absolutely compelling investment. But keep in mind, we're looking to hold these for at least 5 or 10 years, perhaps forever. Most of my portfolio I've owned for 30 or 35 years, and I own an awful lot of ones I bought 35 years ago I still own. So, if they keep cash flowing, there's really no reason to sell them. Now, let me just look at my crystal ball. I think that we have some problems coming on in the stock market. I think we have problems coming in the bond market. I think we have problems in the economy. I think that we need to start thinking that you need to do some asset preservation so that you get your properties with some cash and some stability, and put your capital deployed into real assets. There's going to be a definite shift, my personal opinion, a shift from financial assets to real assets, gold, coal, iron ore, but of course they don't pay much dividends where real estate does, and of course it appreciates in a really good market. So we've been really, really blessed, and we are looking at a cycle for real estate that's going to really run at bottom. I think everyone can pretty much say bottom in 2008. It's typically an 18-year cycle, so we have a really long time, 2026 probably, before it completes. So plenty of time to season a portfolio. A little bit of a correction coming here, but I'm going to tell you, we have this huge debt. Some of my mentors and some of the people I follow are talking about some huge increases in real estate prices and real assets in particular. I'm thinking maybe 3 or 4 years inflation gets unleashed really nastily. So that would be very poor. We're looking at bonds that have problems, which would say rates are heading up, and rates generally head up in an inflationary period. So very possibly we could see 4 or 5 years, we could see some real appreciation on property. So really think it's an asset preservation play. I think it's a cash flow play. I think it's a growth play. So really don't see a whole lot of negatives to this. You just have to remember that we're a little long-term investors, and we're not like trading stocks or a day trader in the S&P. We buy these things, we keep them, we just clip coupons, and we let time be our friend. So, and the trend is our friend as well. So listen, it's Michael. I'm here at Scottsdale, Arizona. It's Michael Douville. I'm sorry to say this, but since my book got published, I've just been incredibly busy. So give me a call here. I'll do everything I possibly can to help you in any way, shape, or form. See you. Bye-bye now.